Hello, everyone. Welcome to this latest edition of 7 Market Movers. My name is Gary Quinzel, Vice President of Portfolio Consulting at Wealth Enhancement. Today, we're going to start with economic growth, which has been showing some signs of weakening. Now, we did have a positive revision of GDP, second quarter GDP, that is, last week. It was revised upward from 3% to 3.3%, but that doesn't tell the whole story. If you look at manufacturing, for example, we like to look at the ISM Purchasing Managers Index, which is a survey, real-time survey of purchasing managers, which gives us some insight as to what's happening boots on the ground. What it's told us is that manufacturing in aggregate here in the US has actually contracted for 6 consecutive months. And if you look further back, there were 2 positive months before that, but 26 consecutive months before that, manufacturing also contracted. So we're in this prolonged period of weakening for our U.S. manufacturing. But that's just one anecdote. I think more timely and more top of mind is that of the labor market. And so last month, when we saw the July payrolls come out, it really shocked us. It was really much lower than most people thought. It was around 75,000 payroll jobs created. And more importantly, we saw negative revisions in May and June. And in fact, every revision we've seen year to date has been a negative revision, which is somewhat alarming in its own sense and somewhat unique. Well, we're about to have the August payrolls report come out. Depending upon when you watch this, it may have already been released. But we are expecting yet another weaker number. And one of the reasons for that is because we also looked at the job opening and labor turnover survey. And so what that tells us is, what are the job openings right now? And so the report that came out on September 3rd told us that job openings declined to around 7.2 million, which is the lowest level in more than a year. The job openings rate slipped to 4.3%, which matched lows not seen since mid 2020, around the time of the pandemic. We also seen the quits rate at its lowest rate since the time of the pandemic. And so, what does this all mean? It means that the number of unemployed workers essentially matches or exceeds job openings. And that's really significant because it means that demand for labor is cooling and businesses are no longer hiring at the same pace. This matters because the labor market has been the backbone of US growth. Strong hiring supports consumer spending, which in turn has helped the economy withstand tariffs, policy uncertainty, and the higher rates for longer environment that we've been in. So we talked about the quit rates trending down. We may be approaching an inflection point where softer labor demand begins to spill over into slower consumption and overall growth. That brings us to our next market mover, which is monetary policy, the Fed's dilemma. So softer labor data has fueled expectations that the Fed is going to cut as soon as the fourth quarter. In fact, if you look at the Fed futures, the bond traders that are predicting the next move, there's currently a 98% probability that the Fed is going to cut in September. And if you take it a step further, there's about a 90% probability that there will be at least one more cut beyond the September cut. So between 1 and 2 cuts seems to be priced in. But here's the dilemma. While inflation has moderated, new tariffs on imported goods could reintroduce price pressures later this year. So the Fed is kind of walking a tightrope. On one hand, a cooling labor market gives them the cover to ease policy, but on the other, premature cuts could reignite inflation at a time when the Fed is trying to declare victory. So this is the essence of bad news is good news, because the bad news of a weaker labor market has propelled market participants to be excited about rate cuts and essentially apply that to their forward-looking projections and be more pro-risky assets. On the other hand, weaker labor data could mean slower economic growth. And while we're not predicting a recession at this point, when we do see unemployment get higher, it can move higher very, very quickly. And so we could see an uptick in unemployment. We're not predicting recession at this point, but we are in that paradox right now of understanding, is bad news good news or is bad news bad news? And so more to come on that. But that brings us to the last market mover, which is investor sentiment. It's an interesting time right now. We've seen the University of Michigan Sentiment Index tick lower. That can be ebb and flow quite a lot based upon a lot of various factors. But I think more notable is valuations, right? Valuations are definitely at some of the most all-time highs that we've seen, historic highs. You look at the forward price to earnings ratio on the S&P 500 around 22.5. It means that investors want risk. They're excited about the artificial intelligence tailwind. They want to be part of this tech growth rally, which has added a lot of money to their wealth. And so we've seen a lot of elevated valuations, and of course concentration risk, right? And so many folks flocking to those Mag 7 stocks, those top 10 stocks in the S&P 500, which make up 40% of the overall index. And so another consideration to take into account is that September is also historically the weakest month of the year for the market. And so over the last 50 or so years, S&P 500 has actually averaged a -2%, -1.2% return over September for a variety of reasons. It creates an environment where sentiment is somewhat constructive, but we're in a very fragile time period due to those factors, due to the fluctuations in investor confidence, sentiment, the seasonality component, and the mere fact that we are getting later in the cycle. So just a quick recap. Economic growth, we're losing a little bit of momentum as the labor market cools, and it's showing some signs of fatigue. We're not seeing signs of completely falling out of bed at this point, but we are very cautious. Monetary policy is certainly supportive because we are expecting rate cuts. That should be good for risky assets, but we want to be very aware of why the Fed is cutting and how fast they're going to cut. And lastly, investor sentiment certainly ebbs and flows. We're seeing a lot of risk-on appetite right now and low volatility, but as we move through this seasonally volatile period, we want to be aware of the potential for higher volatility at any moment. That's all I have for today. I hope you found this week's update useful. As always, please reach out to your financial advisor if you have any questions, and we'll be happy to get back to you. That's all. Take care. Have a great day.